All right, welcome back. It was about this time last year we had those minor issues with our regional banks. The stock market got a little wobbly, remember? And it only wobbled again in October. But all in all, it's been a buy-the-dip scenario. But after this first quarter this year, I feel like those wobbles are kind of sneaking back in a little bit. Slowly but surely, we've gone from a buy-the-dips to maybe a sell-the-rallies while this inflation data comes in a little stronger than expected. And then it's been pushing out those rate cut expectations to the end of the year or maybe even early next year. Now, with those expectations that the Fed will cut interest rates fading, signs of inflation remaining sticky, and stocks still trading at higher than average valuations, well, many believe the market is in a similar position to where it stood entering that 3-month downturn, which was the late summer fall, like October, September of last year. Now, price action may depend on earnings and could stabilize near term, says J.P. Morgan's chief market strategist, Marko Kolanovic. He's pretty widely followed. He wrote this on Monday, yesterday. But he says, beyond this, however, we think the sell-off has further to go. We remain concerned about continued complacency and equity valuations, inflation staying too hot, and further Fed repricing, and a profit outlook where the implied acceleration this year might just be a little too optimistic. Now, that is a mouthful, but there's only one person that I want to decipher all that for us, and that's Mr. Craig Bolanos, the CEO of the Wealth and co-founder of the Wealth Management Group in Chicago. I've always been a little bit skeptical of the stock market. You know me, where I stand on that. Mr. Kolanovic is kind of speaking to the choir, if you ask me. But where do you stand on this? Because I know that you're more of it's wealth management, right? You're more long term. You're not in and out of the market a lot with people's 401ks and the likes. How does that look to you, sound to you, and what are your thoughts?
Well, sure. I mean, Scott, at the Wealth Management Group, we're a long-term investor, but you still have to trade around some positions at the margin. There's no doubt. And I hearken back to what you and I talked about, 8:30 Eastern time on Friday, just last Friday. I said, hey, as soon as we went near 5,000, I think it was a buy the dip mentality. And so far for a day and a half, that's proven to be right, because unless one of four conditions arises, and we could certainly talk about those four if you want, I think this party's going to continue. And when I hear people talk about the drop has further to go, that's kind of like politicians saying the wealthy should pay their fair share in air quotes, but they never define who the wealthy is. In the same way, if we're going to define drops and we're talking about maybe repricing the S&P to 4750, that's not financial Armageddon, is it?
No, not at all. And we've already, correct me if I'm wrong, but I think we had roughly a 5% sell-off in the S&P and the NASDAQ just as of late. And we seem to have digested that fairly well, right? And if you had another 5%, we'd still be probably sitting here talking about how the market is still okay. Those things aren't crazy. They do happen. They have happened before. I just think that we have expectations from folks that graduated in 2008 that have only ever seen 0% interest rates for 15 years that think the market only goes up and interest rates always stay at zero. Now, they've been disappointed on the interest rate front, and they love to hear about rate cuts because that drove the market up even further. But an 8 to 10% return on your stock portfolio when I was going through all my schooling, and I still think is a pretty good return. But the expectations since especially COVID, have been outsized. Wouldn't you agree?
Oh, yeah. The capital asset pricing model still exists, Scott, and strong single-digit returns in equities are just fine. And I think if I were to say, hey, so much of this is always about interest rates and maybe what tripped up the Fed, well, maybe I shouldn't say it's what tripped up the Fed. It's probably what tripped up Congress. I would argue if we wouldn't have had nearly the amount of fiscal stimulus that we've had, the monetary policy curtailments that have already been enacted would have made us in an okay position. But let's be sincere. As long as growth doesn't slow, as long as rate hikes don't go back on the table, they're not. As long as oil prices don't spike to the moon, although I get worried about people lobbing missiles in the Middle East, and as long as the AI enthusiasm doesn't yet wane, and we're about to have all those tech earnings this week, I think this market remains intact, and people should be looking. If they're out of the market, they should cure that FOMO by getting invested. And for everybody else, you should just be rebalancing, because strong protocols win the end game.
All right, now I'm going to throw you a little bit of a curveball, and not just stocks, but we're going to talk about bonds for a second. they have been more competitive as of late. Now when we had 0% interest, bonds were not competitive at all. But when you start looking at a 2-year Treasury of 5% return, that starts to become a little bit compelling. Have you moved any of your money or your customers' money over into something like that? Because if you've got a chunk of change, to take a 5% return on it for a couple of years is not maybe a bad idea. Not all of it, but maybe some of it.
Yeah, let's be sincere. At the Wealth Management Group, we've done a couple things right on the fixed income side. Number one, it's just laddering treasuries has been a godsend all through 2023 and thus far in 2024 relative to the benchmark being the aggregate bond index, which has total return staunchly in the negative yet again this year. But if people are looking to get invested in what I call safe money strategies, participating in fixed income with known maturity dates, target outcomes, assuming we do get those 1 to 2 rate cuts, which I still think are going to come, Scott, this is strong starting yields combined with the potential for total return over the next 2 calendar years, because I think the bulk of the rate cuts we had hoped for, we're not going to get until 2025. That makes the total return parameters for fixed income bonds look really, really good at this day and age in the spring of 2024.
Yeah, that's one of those things we're looking at too, and it's hard to argue with those. If you've got a chunk of cash in there and you want to put some of it aside and have it guaranteed and get a guaranteed return over a certain period of time, it's definitely competitive. That's for sure. I'll say that now. But appreciate you coming on. Always great to hear from what you have to say, because you're one of the smartest guys in the room for sure. If it's just you and I in the room, you are the smartest guy in the room. That's for sure. Thank you very much for being on this show. Greg Bolanos from the Wealth Management, co-founder and managing partner or CEO of the Wealth Management Group in Chicago.